Okay, so in the last part of this class, we looked at assumptions that are made by market participants when we are determining fair value. And I related those assumptions to the elements because those elements are the definitions and those assumptions are based on those elements. The only addition were the fact that um, is the price in the principal market and the most advantageous market that we consider as fair value. It is an assumption that is made. Also, for non-monetary assets, the fair value will be the value you will get from their highest and best use, the one that gives you the highest use. And they also assume that the transaction is orderly, right? And of course, they also assume that is the price at the reporting date or at the measurement date that is the fair value. Those are the assumptions made by market participants. Now, beyond all of that, there are series of assets that we can have. And it's important that we have a structured way, not just considering those elements randomly. We need to know that, okay, if this is the price you receive, we need to be able to say, okay, this is the approach you have used. Because there are some assets, like I gave you examples of a private company that you want to get its fair value. You know, that one indirectly, the fair value necessarily didn't translate to what we received. I said we use a discounted cash flow. Ultimately, if they were going to sell, even though that's the price they will have received, but we had used an approach in determining that what? That fair value. And that is why approaches to valuation or market or fair value is important. And there are three techniques or approach that we use in determining fair value. We have the income approach. We have the market approach. And we have the cost approach. We have the income approach, we have the market approach, and we have the cost approach. Now, for the income approach, look up so that you understand it. For this approach, you see, the fair value that we get here is determined or priced using what we call what? And for some of you that are doing fair value, that are doing SFM, you might already be familiar with discounting when you have future cash flows. That is all this approach is all about. And this approach cannot be used for all assets. It can only be used for probably you want to determine fair value of, let's say, a private company, or you want to use fair value of, let's say, a long-term contract. Okay, when you have a long-term contract that they gave you a contract for 5 years, and you want to get what's the value of this contract, you can use DCF. Okay, so it doesn't really apply to all assets. These are the assets that you have no choice than to use income approach. Okay, so this approach determines fair value by using which method? Discounted cash flow method. You see, this market approach, from the name market, that means this one will use market information. Market information of identical or similar assets, of identical or what? Of similar assets in an active market. Market approach, you will use market information of identical or similar assets in an active market. That's one. Market approach will also include market data or information of a similar asset in an inactive market. This is market approach. Because when we say markets, there are some markets that are active, that everybody knows that this is where you get market data on these assets, on that same asset. And this one will be talking about maybe the stock market or a bond market. Okay? So these are active markets. But an inactive market, this one, probably you are looking at um, maybe a real estate market, will be an inactive market in the sense that the market data you will get will just be, it cannot be for that same asset. It's not like the prices are quoted for that asset. It will be for a similar what? For a similar asset. You are still using market information. Okay? But we call that market what? Inactive market. Which one? Oh, the companies. We have private companies. And we also have long-term contracts. That is where this one can be used. For this one, the market approach, assets operating in the stock market or probably in a bond market for identical assets. Okay? And when I say identical, I'm talking about that asset itself. It's quoted prices. But in some other markets that are not so active, in the sense that their identical prices or their own price is not quoted, you probably have to use prices of a similar asset. Okay? Like the real estate market, for example, now. Those ones, they are also market information. The way we determine their fair value is using the market approach, but it is in an inactive market. You can only use prices of a similar asset. Prices of a similar asset. And again, you cannot even use that price hook, line, and sink like that. Because they said they sold that one for 750 million. You want to sell your own. You need to look at are they entirely similar? You need to look at the location. You need to look at the characteristics, how many bedroom, and all of that. A lot of adjustments need to be also made. Or probably, you bought bonds or you bought debt instrument and there's no active market for it. It's not quoted anywhere that you can know what the prices are today. Again, for that also is an inactive market because you would have to use market information of similar bonds that may be quoted. Something like that. Okay, the third one, which is the cost approach. So the cost approach determines fair value by looking at replacement cost or reproduction cost. Cost approach determines fair value by looking at replacement costs or the cost of reproducing a similar asset. And you agree with me that the asset here will probably be asset like PPE and other non-financial assets. Those are the ones that we'll be looking at. If I have an asset and I want to replace it today, how much? So, I mean, using cost approach is like saying you have an asset that you bought 5 years ago for 1 billion. And if you want to replace the asset today, you would have to spend something like, if you want to replace the asset today, you have to spend something like 1.2 billion. Is 1.2 billion the fair value? No. The reason is that you need to consider depreciation and obsolescence, because a replacement that you are looking at that they are pricing for 1.2 billion might not be as old as the one you have that you bought 5 years ago for 1 billion. So if the question now give you information around, they gave you the cost, they gave you when you bought it, that means you should calculate depreciation, right, on that, or obsolescence. Then by the time you remove depreciation on that same asset, whatever is remaining, so it's like the replacement cost minus depreciation that would have what? That would have occurred on that asset. And that is the cost approach. So far, what we really want you to be able to do is they are not really giving you scenarios for you to use cost approach, for you to use income approach, for you to use market. They have not really done that, which I believe they should do, because it's still going to be straightforward for you. What they have done so far is just asking you to list and explain the evaluation approach for fair value measurement, and they give you 6 marks for that. That's two to each. Okay, your ability to actually tell them the method and examples, the method and examples, the method and examples, the method and examples, something like that, would give you or would have earned you your 6 marks. And those are the valuation approaches or valuation techniques to fair value measurement.